Welcome for another report on the gold market. Gold's prices showed little volatility in the past 12 days, yet seem to maintain a downward movement despite some outbursts to the upside. On the precious metals fundamentals, market sentiment seems to be influenced by the earnings season of the US stock markets, while we also note that US Treasury yields seem to be rising in the past 2 days and market focus is turning to the Fed's interest rate decision tomorrow, which could create considerable volatility for gold. The Fed's meeting starts today, Tuesday the 27th of the month, yet the interest rate decision is expected to be released tomorrow the 28th and be followed by a press conference of Fed Chairman Jerome Powell. The bank is widely expected to remain on hold, and the main issue may be the bank's intentions regarding its sizable QE program. Practically, the bank seems to be facing a dilemma between curtailing its asset purchases in order to curb inflationary pressures in a recovering US economy and continuing to keep the program unchanged to support the economy, given the uncertainty created by the Delta variant of the pandemic. Should the bank decide to adopt a dovish tone, we may see the USD as well as US Treasury yields retreating, thus providing an opportunity for gold's prices to reverse the downward movement and rise. On the contrary, should the bank decide to adopt a hawkish tone, signaling that it will start tapering its QE program rather sooner than later, we may see the USD and US yields gaining, thus undermining gold's prices. In every case, the event should be kept under close watch by gold traders, as it could create considerable volatility for gold's prices, while Powell's press conference later on could prolong any possible fluctuation of prices. However, it's not only the Fed, which is in play here, affecting the market sentiment for the bullion. We should take into account also that the US stock markets are going through another earnings season, which catch traders' eyes and shifting capital flows from gold towards the stock markets, given how many headlines are being created regarding releases during today and the next days. Also, we would highlight the course of US Treasury yields, which recovered somewhat after reaching a low point on the 19th of the month, yet their downtrend seems to remain intact. Historically high US yields tended to undermine gold's prices, as bonds acted also as a safe haven in times of crisis and bear interest, in contrast to gold. Another factor which could come into play is the uncertainty created by the surge of the Delta variant on a global level. Should market worries intensify for a possible adverse effect of the variant surge on the recovery of the US and global economy, we may see safe haven inflows feeding the greenback, which tends to have a negative correlation with gold's prices. Thus, should such worries be on display, we may see, at least initially, the USD gaining, thus gold prices may weaken as the precious metals denominator appreciates. Also, a number of financial releases, especially from the US, are due out in the next days that could create some volatility for gold's prices. On Thursday, we get the US GDP advance rate for Q2, which is expected to accelerate and if so could create some support for the USD, as well as the weekly initial jobless claims figure, and on Friday we get the US consumption rate for June. On Monday, we highlight the release of the ISM manufacturing PMI for July, and on Tuesday the factory orders growth rate for the same month. Moving now to the technical analysis and gold's forward chart. Gold prices retreated yesterday, breaking the 1800 support line, now turned to resistance. We tend to maintain a bearish outlook for the precious metal as long as it remains below the downward trend line incepted since the 15th of July. We also note that the RSI indicator below our forward chart is between the readings of 50 and 30, also implying that the bears may have a slight advantage, while the 50 moving average has slowly started to negatively diverge from the 200 moving average, which reflects the recent downward motion of gold's price action, yet the narrow gap of the two MAs reminds us of the low volatility present for the precious metal, resembling somewhat the calm before the storm. Should the bears actually maintain control over the gold's direction, we may see its prices aiming for the 1763 support line, which served the precious metal well on the 21st and the 29th of June. Lower than that, we have noted the 1723 level, which reversed gold's downward movement on the 13th of April, while the lowest level noted in our chart is the 1680, which has not seen any price action since the 31st of March, when it was tested yet not breached. Should the bulls take over, we would expect the bullion's price to break above the 1800 resistance line and aim for the 1835 level, which capped gold's upward movement on the 15th of the month, and higher than that, we note this 1870 resistance level, which prevented the precious metals rise on the 15th of June, while the highest level noted in our chart would be the 1904 resistance barrier that was tested but held its ground on the 11th of June. Thank you very much for your time and focus. We appreciate your participation, and if you like this video, please feel free to share and subscribe. Please note, as an effort to support traders on as many fronts as possible, we are now presenting live weekly webinars on trending subjects, and all our subscribers are welcome to participate. For everyone here at IronFX, best wishes for solid trading.